Hello and welcome to your weekly Go No Go show. My name is Tyler Wood and I am joined by Alex Cole. How are you on this fine February 16th, sir?
I'm very well, thanks. How are you?
Doing well. A little under the weather. The Dr. Wood household is fighting off some kind of cold, but the band is playing tonight in Syracuse, so I better get over it quick. I think we finish around 2 a.m. So glad we're recording today, not tomorrow. Let's dive right into what is heating up in a first look at the GoNoGo Charts cross-asset heat map. How are we doing from a top-level perspective, Alex?
We're doing all right. Let me put the S&P in the top here, but you can see that the trend in equities has remained in place. We've had people talking this week about how each day is different. One day we're up, one day we're down. But if you look at the trend of equities, you can see that we have been able to stay in a go trend. And in fact, are painting strong blue bars at the end far right of this panel here on the top. Treasury bond prices have struggled and rolled over, and as has commodities now for over a week been in a no-go trend. And here's the interesting one, the dollar painting its first couple of go bars for several months.
I know we just passed Groundhog's Day, but this configuration of intermarket approaches seems very reminiscent of what we were talking about a lot in 2022. Let's check in on the S&P 500 at the index level first and just see what the go trend conditions are looking like first on a daily basis. And then we'll zoom out and try to understand what we're seeing from a primary trend. Our good friend Jim Bianco, also a CMT charter holder, was mentioning how many days in a row, 10 days of reversals of at least 1%, many 2% in this kind of chaotic range-bound mess. What are we seeing from a trend perspective here, Alex?
Yeah, I mean, that's amazing to think about that kind of fluctuation on a day-to-day basis. But if you're just to look at the go-no-go trend conditions, then you can sort of hopefully ignore a lot of that noise and just know that at the moment, the weight of the evidence suggests we're still in a go trend. Now, we'll look at some of the macro factors that might sway your thesis a little bit. But what we'd be looking for here is whether or not the oscillator finds support at the zero line. We have a go trend in place. We see this pullback. This looks like it could be shaping up to look a bit like a flag or some sort of correction against the trend. We saw that counter trend correction arrow here. And we're going to look towards the oscillator now and see if it can continue to find support. So while we're at the zero line, we're going to be quite careful. We're going to be looking to see what happens. If we grow below zero into negative territory, obviously you can see what happens when that's happened before. We've had a go trend in place. We've had a correction, and then the oscillator fails to hold the zero line. That leads to a deeper correction. So this time we're going to look and see if the oscillator can hold that zero line. If it does, then equity prices may have the legs to try to go higher again. But it's going to be very important to see if momentum stays on the side of the trend.
Certainly, before the advent of computing power, when analysts hundreds of years ago had to do this just by visual analysis, there was some more subjectivity in place. But this looks like a textbook example of the concept of polarity. So when we look at those prior highs from December, holding up now, what was resistance becomes support.
That's right.
As we continue to test that. That's the bottom end of the channel that we're in. And really, what as technicians, what we are capturing is sort of the emotions and the sentiment of the market. So we break out to new highs above those December highs, and we have to consolidate. Right now, certainly what I see in financial news media is nothing but very bearish thesis around the economy, talking about end of days in Q2. And so we're seeing that tug of war between buyers and sellers at the index level, creating this range-bound territory.
And it's interesting because with that thesis that's out there, the prices are holding up better than you might expect.
Yes.
Like you said, these areas of support that were highs here were also highs, if you remember, back in September of 2022. So this is a level that's going to be very, very interesting. And I can imagine that if that level gets broken to the downside, people might pile into that movement down.
As the great Luis Yamada told us, when in doubt, zoom out. So if you are looking at very short-term trading time frames, certainly step out to that daily period to get a sense of how that range-bound activity is adding up. But let's look at the S&P 500 on that weekly basis, Alex. It seems to be very constructive and yet not fully confirmed.
Yes, it's almost as if it's afraid to commit to anything else.
Well, it's just Valentine's Day, Alex. The market might be a little, keeping its options open.
A bit wary of relationships at this point. But no, you can see, you can see how the amber goldfish bars just continue to be painted on the chart. But like you said, something constructive, definitely a higher low. This potentially a slightly higher high in a sort of short intermediate term basis, and the oscillator finding support at 0 and rising into positive territory. So we're not, on the long term, we aren't as bearish as we were. The daily is still in a go trend. And as well as I do, Tyler, that the markets can confound the best of people's expectations, and they can really challenge any thesis we might have. So the economy may look in really bad shape, and people may be predicting some tough times ahead, but it's not to say prices can't go up for a little while further.
Absolutely. My good old friend Craig Johnson recently had some very bullish calls, really in the face of Piper Sandler's director of economic research. And so they're seeing things differently. And she might be looking at more macro factors, and he's looking at what the market is telling us. So I certainly see constructive evidence on the right side of that chart. But let's take a look at what Nancy Lazar and other economists are looking at in terms of those intermarket forces, some of the macro effects at play that could impact our equity positions. Let's start with a chart of the TNX. And so you mentioned in that cross-asset heat map, we've got bond prices selling off into no-go trends. So remember, this moves inversely to the prices of sovereign bonds. Here we're looking at rates or yields. I'm seeing go bars on the right side of that chart, Alex.
Yeah, we certainly are. And they're strong blue ones as well. We're just coming up to test prior highs, so we'll take a look to see if we can get past those levels. But this several month relief that we experienced as the no-go was in place for rates, perhaps providing a bit of lift for equities, certainly seems to have changed course now. We went through a string of amber go fish bars and now into strong blue go bars as rates continue to rise. Oscillator in positive territory, not yet overbought either. So let's see what happens as we get to these levels that were highs back in December. But yeah, certainly a go trend in place now on rates.
Absolutely. Another contrarian indicator for us on the bullish thesis, the US dollar has been showing signs of strength after what had been a very sharp sell-off in the dollar index. Tell us what you're seeing from a go-no-go perspective, in particular, that strong signal from the go-no-go oscillator and the positive momentum for US dollars.
Yeah, we saw this happen ahead of the change in trend. So the no-go was in place. We were seeing lower lows and lower highs, and then we saw this sort of rally off the bottom here, and we saw the GoNoGo oscillator break into positive territory on heavy volume. So that was a sort of first sign that perhaps there was something happening that was going to be against the nature of the current trend. And then we saw this sideways movement on neutral bars, those uncertain amber bars, before finally now painting two consecutive go colors. Now, they're not particularly convincing. These are aqua bars, and you can see how we're opening higher than we're closing on these two bars if things stay the same today. But definitely the weight of the evidence saying that this no-go trend for the moment is over. Now, what I did want to just point our attention to is that there is a definite level of resistance here that we can see. It was support here, that concept of polarity that you talked about, support quickly becoming resistance again here. So as we rise towards that level in these fresh go bars, be very interesting to see if this go trend has the strength to get above those levels.
Absolutely. Let's take a look at gold as sort of the point and counterpoint to US dollar strength. We had seen a pretty sharp rally, and for all the gold bugs out there, that was very happy times. Where are we at right now on this chart of gold?
Well, right now we're in a no-go trend, and it's not looking good. We've broken below this level that was sort of support here. We've fallen into strong purple no-go bars. And again, look at the oscillator. The oscillator supported that no-go trend all the way until it didn't anymore. And then when it didn't, it was broken quite sharply on heavy volume. And that was sort of our first indication here that this move lower was the start of something more. So we saw weaker aqua trend bars. And then we've seen, obviously, the momentum turn negative. And then that was, of course, finally followed by the no-go starting on gold. So beginnings of a no-go on gold, the beginnings of a go on the dollar, beginnings of a go in treasury rates. You can read all you want into that. That's what the charts are telling us.
Absolutely. Sticking with this commodities theme, let's pull up a chart of nat gas, which has been a strong underperformer in the commodities index. And for everybody who is using GoNoGo charts to trade to the short side, I think this is a great example of how we might follow trends in either direction. Alex, talk to us about what you're seeing for nat gas.
Well, it's pretty horrible looking, isn't it? I mean, unless you are playing to the short side. But what we want to look at when the trend is in place are these trend continuation icons. So that allows us to participate in a move that perhaps is already in place. So every time we see the oscillator rise to challenge the zero line and get turned away, that's going to tell us that momentum is resurgent in the direction of the current trend, which of course is a no-go. So these red circles are no-go trend continuation icons. And you see them again once the no-go takes hold again here. You see a continuation icon. You see another continuation icon here. Now, if anybody was paying attention just now, there was another one on the chart right here. And the oscillator was actually dipping into negative territory. So perhaps a good moment to point out that GoNoGo charts update in real time as this bar is painting and being calculated. Depending on the current price, you may or may not see something on the chart that's being calculated and therefore being displayed. So when this oscillator was dipping into negative territory just now, we saw a red circle on the chart. Of course, now price has risen a bit off the lows and we're at zero on the oscillator, so that trend continuation icon isn't there. But if we finish the day in negative territory, then that would be drawn on the chart and of course never removed. So perhaps an opportunity coming for a continuation. We'll have to wait and see what happens at the close of the day.
Absolutely. Here at midday on February 16th, signs are pointing for further downside momentum here in this chart of natural gas. All right, Alex, let's take a look at the S&P 500 under the hood. Remember, it is not a stock market, but rather a market of stocks. And so we want to make sure that we're positioning towards leaders, trimming positions amongst those laggards. And for that, we're going to use a GoNoGo Sector RelMap. And what this is going to do is take each of the sectors of the S&P 500 and build us a little ratio chart of that sector's performance against the benchmark. And so you see these bands in the heat map that's showing us the ratio and just the trend colors. So we're not looking at the price action of those ratio charts. We're just trying to understand the concept of trend on a relative basis to the benchmark. What a massive and clear rotation out of certainly the defensive sectors like healthcare, staples, and utilities. Those rolled over first. Now in the cyclical sectors of the market, energy, financials, industrials, and materials. And what's leading in this upward moving S&P 500 Go trend are our growth equity sectors: technology, communications, and consumer discretionary. Alex, anything else that's really leaping off this chart to you in terms of the relative performance of these sector groups?
No, like you said, it's just such a nice way to visualize the clear rotation that we're seeing. And it certainly is now the growth sectors outperforming. Now, remember, outperformance doesn't mean doing particularly well in its own right. So with the markets being a little bit choppy as they are, but you want to be doing less badly than the sectors that are perhaps underperforming. And so you will see in a little while how these are in their own go trends. But just remember that if the market does take a turn for the worse, you still want to be in the sectors that are outperforming in relative go trends, with the hope then that you would lose less than if you were in the market as a whole. The other thing that jumps off here just real quick is that for the first time in a long time, real estate has rolled over as well. So now we're really seeing only outperformance in the growth sectors.
Now, of course, it's all time frame dependent. I feel like most of the heated battles on Twitter would end immediately if people just clarified what their horizon was for their trade. So when you think about those positions that you were holding through the bear market of 2022, cyclical sectors like the industrials and materials, they might still be in an absolute uptrend, right? Still gaining, but against the performance of the index, they are underperforming. That's what we're looking at when we're looking at a relative ratio chart. So right now, and the last week and a half, we've really seen those growth equity sectors outperform, and they obviously stood to gain the most as they were the most beaten down areas of the market. So for those looking at shorter time frames and looking for those trade ideas, let's focus on what's leading right now. And Alex, why don't we pull up just the technology sector ETF, the XLK. Let's take a look at that on an absolute basis to see what the outperformance is all about.
Yeah, so you can see that it's quite a, bears some resemblance to the chart of the S&P, but we're just a little further ahead, a little bit advanced. You can see how we're above these highs. There's a little bit of wiggle room above those highs from earlier in the chart, and we're moving sideways. We're not correcting against the trend quite as much. We're just moving sideways. We're in strong blue bars. Momentum actually never got back to touch the zero line. Momentum stayed positive and has rallied again. So we all know that the tech sector is quite dominant in the makeup of the S&P, so no surprise that the charts look similar, but that the tech sector is just slightly ahead of where the S&P is.
Absolutely. Now, from our analytical work, the way that we've learned from some of the best research analysts in the technical space out there, is that you take a top-down approach. So we've looked at the asset classes. We've now looked at the sector groups of the S&P 500. We've identified those that are outperforming on a relative basis, right? So equities are outperforming our other asset classes. Now we've seen that the technology sector is outperforming the S&P index. Now let's look inside the XLK and take a look at those industry subgroups and how they're performing relative to the sector, right? So you can see that top-down approach. We're narrowing our field of vision in terms of what is outperforming. And if we can be in the industry groups that are outperforming the sector, which is outperforming the index, now we're really working with something that we can have some conviction in. So
Right.
What steps out to me on this chart, and I don't know each and every one of those ticker symbols, but the semiconductors have had a strong period of outperformance even within the technology sector. Anything else that jumps off to you, Alex?
Yeah, third panel here is semiconductors. And with this, you can see with the exception of this blip of one bar here, we've been in a relative go trend, semiconductors to the XLK throughout the period of this chart. Also computer hardware as well coming into its own, but semiconductors has probably been the most persistent of the go trends within the tech sector on a relative basis.
Absolutely. So then if we are looking for ideas within the semiconductors group of the XLK, why don't we pull up a chart of NVIDIA and just see how that is doing on an absolute basis in an outperforming industry group, in an outperforming sector of the equity index.
Yeah, and you can see from the shape of the chart, this is outperformance. You can see these prior highs that were on the other charts as well, but you can see how much further ahead we are. You can see how we're making higher highs here. We're not really moving sideways as the tech sector and even the S&P were. S&P was even correcting a little bit against the trend. So we're continuing to make higher highs and higher lows in NVIDIA, and that's where that source of outperformance is coming from. You can see heavy volume as well, the oscillator turning bright blue on this most recent go trend. So that's encouraging as well. And you might want to be buying dips now in something like NVIDIA. Perhaps you go down a time frame, Tyler, and look at something on a shorter time frame to get an entry as price cools off slightly. If you're looking to get into something like this that's outperforming on a sector and individual stock basis.
Absolutely. Sticking with this chart that's on screen just for another minute, I think following through the life cycle of a trade as a trend follower is always helpful because it's easy to say and it's very difficult to do in practice. So if we look at this chart in October, we reached those lows of that no-go trend. We came back in and fired off a go trend, right? First breaking out of a squeeze, momentum to the upside, and then we signaled a go trend. So taking a position in NVIDIA on the basis of that go trend would be responsible. But of course, we close out as soon as the no-go is struck. So as we've talked about in many of our educational sessions, longer form webinars, the idea of trend following is to really embrace those trades that don't work out, right? We want to own those and quickly exit losing positions because we don't ever know what's going to happen on the right side of the chart beyond tomorrow. Re-entering the trade, while psychologically that might be difficult for some investors to do if they had just sold out of the position 2 days earlier, that is the disciplined approach that trend followers throughout history have recommended. So you re-enter the position, you hold that through the life of the trade. And what's interesting to me in the December time period, as we're coming to the end of that second go trend run, is that we had some early indications. And this is where each individual trader or investor is going to have to establish the risk parameters that they want to follow. So in a go trend, our first signal is the momentum breakdown to negative territory, right? We broke through the zero line ahead of that change in trend color. We have a couple of neutral bars, but we're seeing negative momentum. That's a direct threat to the Go trend that was established. Of course, once it is in no-go territory, we have to follow our rules and exit those positions. And then it's up to the trader again about where you want to take your re-entry. The break above the zero line on heavy volume, we're in neutral territory, and entry on any of those amber bars could be responsible based on your trading rules. But of course, we're seeing a Go trend now that has not yet even retested the zero line. So we've got positive momentum that's staying positive. We haven't even come back to neutral here on this daily chart of NVIDIA. But Alex, according to those multiple timeframes, why don't we step down a notch and see what a shorter term trade might look like?
Yeah, and I think just to tack on to what you said there, what people forget, or when I talk to clients, you have to remember that if you're following a rules-based approach, you have multiple trades that you're taking, and I think that people get into trouble when they stop following their rules based on one that doesn't work, right? So you know, this one didn't work, and then somebody will say, well, that didn't work, and let's go to something else. But if your rules tell you that you want to go long, even if you keep it as simple as go and no-go on this chart, Tyler, go and then get out on the no-go, go and then get out on the amber, or you know, wherever you want to get out here, and then go again. You've got 3 trades in the long direction. One is a small to medium sized win, one is a good sized win, and one is a loss. So if you could be 2 out of 3 in terms of profitable trades, and the one a small loss, then anybody would sign up for that. But psychologically, when you get the one that doesn't work and then you have to buy back in, like you said, at a higher price, it's very difficult. But if you follow your rules, you can see on a chart like this, yeah, this was messy here, but we've had 2 winning trades. So anyway, just interesting to keep that in mind. But yeah, let's jump down a time frame. What should we go to? Like a 2 hour?
A 2 hour would be great. Let's examine that latest
any entries in a 2 hour. Yeah, so you can see now if we drop down to the 2 hour time frame, then you've got so many opportunities to participate in what you saw on the daily chart, because you're getting those retests of the zero line much more frequently than you just highlighted. That there were no retests of zero yet on the daily chart because price has been moving quite quickly. But there's been several tests of zero in the last week or so, a couple of weeks, when using a shorter time frame chart. So you've got these trend continuation icons as the oscillator finds support and rallies back into positive territory. And you've got some recently as well. So we've got a prior high to get above now, but let's see if the support can continue to be found at zero. And if so, we might see it move higher once more.
Absolutely. Alex, I'm looking forward to presenting with you on Monday, the Online Trader Summit. We'll make sure to send a link with this show at 11 a.m. Monday, February 20th. We'll take a deep dive into the process and these tools and how you can be more disciplined in your approach to trading and embracing volatility. For those of you in the Syracuse area, make sure to come out to Al's Wine and Whiskey Lounge tonight. It's been a heavy day in the markets and a choppy week. So enjoy a few blues tunes, and looking forward to seeing everybody here on this Go No Go show next Thursday at 3:30 Eastern. Be well.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.